Farah Mourad, who's Senior Market Analyst at IG Group. Welcome back to the program, Farah. Now, consumer prices rose less than expected in the US in December. So how much does that strengthen the case for the Fed to cut rates?
Thank you, Taiba, for having me. This is also the second softer print. It does definitely support the case. The markets already, even before this print, where they were expecting 2 rate cuts next year. I think this is a little bit different than what the Fed has been hinting to like one, maybe a rate cut during 2026. But the discussion now is mainly about timing, speed, not direction. Something really important that we need to discuss, that despite whatever we're discussing, the fraud, if we would like to name it, between the Fed and Trump, but the financial conditions are loose. Liquidity remains high. Whether it's direct or indirect, we are seeing easing in place. So even if the policy looks restrictive on paper, liquidity is telling us another story. And I think there's definitely more rate cuts than one in 2026.
Right, and gold has hit yet another fresh record this week. How much of this rally is being driven by growing expectations of US rate cuts versus rising geopolitical and institutional risks?
There's definitely politics leaking into institutions, and I think the markets are now pricing or repricing trust, because we're seeing gold and silver obviously going higher. Not only gold and silver, but there's a commodity rally. But then we're seeing also indices at all times high. So I don't think this is a hedge against fear of a total collapse. It's actually a hedge against policies, financial policies, against the dollar itself. This is why I think the fundamentals will keep supporting gold. And also, it's not really a major fear, even if you want to check, let's say, the volatility index or VIX index, it's at all times low. So there's no fear in the markets. Risk is on, but then we're seeing this hedge against, I would say, fiscal policies.
Right. Meanwhile, JP Morgan Chase's chief executive has warned that the Trump administration's attacks on the Fed could backfire and push borrowing costs and inflation higher. How do you interpret that?
It is a possibility, but we need to also remember now we're seeing a lot of political headlines that did not affect the markets. And as I said, indices are at all times high, while VIX index, the volatility index, is really at low levels. So I don't think politics itself or headlines does affect the market, but maybe the independence of whether the federal bank or other banks or the economy itself, once it's being compromised, we might see reaction. But at this point, we need to remember Trump is always starts the conversation on the most extreme note, and then maybe we have this slogan of Trump's always chickens out. So it doesn't necessarily means that we're going to see this huge fraud between the banks and Trump. I think it's a start of a conversation, and the risk is still on, but I don't think the markets are pricing it right now. They wouldn't price it on the short term, especially with the earnings season coming and probably supporting this risk on sentiment we're seeing in the market.
Farah Mourad, Senior Market Analyst at IG Group. Great to have your thoughts.
Thank you for having me.